anyone who is still urging you to invest in China right now, real economy or virtual economy, is not being honest with you. Without a constant flow of new money and new retail investors, those already in the market are trapped at high levels. Recently, many so-called experts inside China have been pushing a new idea that the stock market will become the engine of China's economy. Let's be honest for a second. This claim is totally bullshit. A virtual economy without solid support from the real economy can't drive economic growth, and it certainly cannot function as an engine. Overhyping the stock market like this in China's economic situation continues to decline. The real estate is clearly no longer sustainable. More and more experts, state media outlets, and policy commentators have begun promoting a new narrative. Starting next year, China's pillar industry will no longer be real estate, but the stock market. And the state has already decided to turn capital markets into the new economic core, and that ordinary people actively enter the stock market. Let me be very clear. This narrative does not hold up to even basic economic logic. And let's start with something simple. What's the real estate? Real estate belongs to the real economy. It's not just a house, it directly drives demands across hundreds of upstream and downstream industries, from land sale to cement, steel, glass, construction materials, to renovation, appliance, furniture, property management, and finance. Every step involves real production and real cash flow. More importantly, real estate satisfies a fundamental human need, housing. Even if the price collapses, the house can still be lived in and used. Now compare that with stock market. The stock market is, by nature, a virtual construct. It is a reflection of the real economy, not the real economy itself. Stocks do not directly create demand. They do not produce goods or service. Trading stocks is simply capital moving between accounts. At its core, it is a zero-sum game and over a negative sum one. If someone makes money, someone else must lose it. There is no such thing as the stock market creating wealth for society as a whole. Pushing stocks and real estate in the same category is already a conceptual trick. Real estate once functioned as an economic pillar because it absorbed labor, drove industries, generated tax revenue, and formed a real cash flow cycle. The stock market has none of these characteristics. It does not produce, it does not consume, it does not create real demand. It only circulates an expectation of ownership inside a secondary market. To put it plainly, even if housing prices crash, the house is still there. You bought something you can actually use. But when the stock collapses, you are left with nothing. Back when stocks were paper certificates, at least they were physical. Now they aren't even paper, just electronic signals. When they disappear completely. Let me give you a simple example. Imagine a company with 150 million shares outstanding, priced at 100 RMB per share. Total market value is about 15 billion RMB. Sounds impressive. You buy 10,000 shares at 100 RMB each, 1 million RMB investment. What happens at the moment? Your cash is gone. What you receive in exchange is nothing more than a number on the screen. If negative news hits and the sentiment turns, selling begins. In China's stock market, with daily price limits, you may lose 10% on the first day. In markets without such limits, like Hong Kong, that 1 million RMB could nearly vanish in a very short time. Day 2, Day 3, no buyers. You can't sell, you can't escape. If the company eventually deletes, your shares become worthless digital records. No asset, no recovery, nothing. Under these conditions, calling the stock market an economic pillar is simply nonsense. So why are so many voices suddenly promoting this idea? China's stock market is running out of liquidity and new participants. Margin financing has already exceeded 2.5 trillion RMB and is moving towards 3 trillion. A large share of recent gains comes from borrowed money, not real savings. At the same time, private funds are almost fully invested. The cash has largely been converted into stocks. Without a constant flow of new money and new retail investors, those already in the market are trapped at high levels. When margin loans mature and private funds face redemption deadlines, they are forced to sell. If sellers overwhelm buyers, prices can only fall. This is not a normal correction. It is a structural risk, even systematic risk. So what we are seeing now is not economic transformation, it's a familiar pattern, bringing new people to absorb the existing losses. The CCP has never been particularly concerned with who bears the cost. As long as the number holds for a while longer and the risks can be delayed, that is considered success. If there are still household savings, why not redirect them into the stock market to keep the system running a bit longer? That logic too is bullshit. So if anyone tell you, online or offline, that in 2026 China will make the stock market its pillow economy, you can safely conclude one thing: they are misleading you. Today's China, the most original strategy is not chasing returns, but avoiding systematic risk. If you can hold foreign currency, just do it. If not, consider alternatives like stable assets or physical gold. And if nothing else, keep control of your cash. China is not experiencing a temporary slowdown, it is going through a structural breakdown. In such an environment, trying to outsmart the system through clear investing is a losing game. So I'll end with this. Anyone who is still urging you to invest in China right now, real economy or virtual economy, is not being honest with you. Someone who genuinely cares about you will tell you something much simpler. Protect your money, stay alive. That matters more than anything else.